Have you ever wondered how central banks can dramatically influence the entire economy, even beyond adjusting interest rates? Quantitative easing, often called QE, functions as a powerful monetary policy tool where a central bank directly injects liquidity into the economy by purchasing large quantities of government bonds and other financial assets. The core mechanism behind QE is quite straightforward. By buying these assets from commercial banks and other financial institutions, the central bank increases the money supply in the financial system. This process has two main objectives. First, it lowers long-term interest rates, which encourages borrowing and investment by businesses and consumers. Second, it expands the balance sheets of commercial banks, providing them with more funds to lend. This directly stimulates economic activity when traditional interest rate cuts are no longer effective, typically when rates are already near zero, a situation known as the zero lower bound. In practice, a central bank like the Federal Reserve announces a QE program, specifying the types and amounts of assets it intends to purchase over a period. These purchases are executed in the open market, primarily from primary dealer banks. The central bank credits the bank's reserve accounts, effectively creating new money. This influx of liquidity is intended to flow through the financial system, lowering borrowing costs, increasing asset prices, and boosting confidence, ultimately fostering economic growth and stable inflation. One critical nuance is that QE is distinct from traditional open market operations, which primarily target short-term interest rates. QE, by contrast, focuses on longer duration assets, directly impacting long-term yields and increasing the monetary base significantly. This unconventional approach is often a last resort when the central bank has exhausted its conventional tools. Understanding quantitative easing reveals how central banks navigate challenging economic conditions to promote stability and growth. By expanding the money supply and lowering long-term interest rates through asset purchases, QE provides a critical lever to encourage lending, investment, and consumer spending when conventional monetary policies are insufficient.